Hi, welcome to another video of what's moving the markets. And within the financial markets, of course, one major component is the equity market, the other one is the bond market, and actually different things are moving them. They are showing that they are disagreeing. Equity market thinks we're going for a soft landing, whereas your bond market thinks we're going for a recession. And we will also look at possible data points which they might be looking at to believe what they believe. So first of all, as we have been discussing in the previous weekly videos, that inflation is going to be stubborn. It's going to be persistent. It's not going to go down that easy. And that has what has happened this week, that your core CPI, which excludes the volatile components of food and energy, rose 0.3%, which is higher than what was expected. So it is being stubborn, right? Now, what does that mean? It means that the Federal Reserve, as far as inflation is concerned, would want to keep the rates high because they want to control inflation. They want to bring it down. And that's part of what they're supposed to focus on, right? The Federal Reserve has a dual mandate, which means on one hand, they have to keep the inflation low, but on the other hand, they have to keep the unemployment low as well. Now, I will talk about unemployment shortly, but when we talk about inflation and when that data point came out, which is on this day, look at what happened in the market. So first of all, let me explain what this chart is. This is the CME Group's Fed Watch tool. And that's where the data is coming from. So the data is coming from the CME Group, and Wall Street Journal put together this chart. And what it shows is that because inflation was high, then people who are trading in these federal funds futures contracts through their trading decisions have shown us that they feel 85% chances that only a quarter interest rate reduction, a quarter point interest rate reduction is going to be there, and only 15% chances that half a point or 50 basis points, which is 0.5% cut, will be there. Now, why again are they expecting a lower cut? Because inflation is high and they feel that the Federal Reserve will not want to cut the interest rate so much. They would want to keep it higher for longer, so they are able to control these inflationary pressures and bring them down. So because inflation is high, inflationary pressures are persisting, the Federal Reserve might possibly delay their expected rate cuts or might do smaller cuts than the bigger ones that should be there. Now, what happened later on? So as you can see, this came down and the other one came up. So now the market is almost 49% expecting a 50 basis point cut, whereas 51% they are expecting a 25 basis point cut. So why did the market suddenly start thinking that, something is happening, the Federal Reserve might end up going for a 50 base point cut? Now, what happened? The labor market data came out, right, after the inflation data. And what the labor market data shows is that unemployment is going up. So jobless claims, unemployment claims went up more than expected. And if you watched the speech of the Federal Reserve chairman at the Jackson Hole Symposium, he made it very clear that their focus is now on controlling or keeping unemployment low than inflation. So their focus has been on bringing inflation down, but now they're not that much worried about inflation. So even if it is being a little stubborn, they don't care about it that much. What they are really now focusing on is that they want to keep the labor market from falling apart. They want unemployment under control. They don't want people to be unemployed too much, right? which means that to support the economy, they might even reduce the interest rates 50 basis points, right? Half a percent instead of the 25 basis point. And that's why you see the probability that people were expecting that only 15% chance of 50 basis point cut has now gone up to almost 49%, which is good. I personally also think they should cut 50 basis points at least, right? Because this jobless claims going up is a dangerous thing. And what do you think your bond market is thinking? Bond market is thinking that maybe we need to do even more than 50 basis points. And I'm going to come to the bond market and tell you why I am saying that they feel that the interest rates should be reduced faster, and why they think that there is a recession on the card, which means the Federal Reserve should quickly reduce interest rates to stop that recession from happening. But the equity market is not showing any expectations of a recession. They think that everything is looking amazing. All sectors have been going up, and whether it's a soft landing, which means a gradual rate cut is there and the economy doesn't go into a recession, or the economy goes into a recession and aggressive cuts are there, either way, the stock market is looking forward to a lot of rate cuts, whether they are gradual or aggressive, a lot of rate cuts, and they are celebrating. Specifically, some sectors we know have been doing particularly well. So I've been talking about the utilities sector for quite a few videos now, that in technology, obviously, you've got NVIDIA, which makes the chips, but then there's data centers that buy the chips, and then they buy electricity from utility companies. So utility sectors are very interesting because they have a high dividend yield. So as interest rates go down, defensive stocks that have higher dividend yields, such as utilities or real estate, 3%, consumer staples, 2.2%, they become attractive because if you can't earn a high interest rate in the bank, you can buy these stocks and earn this high dividend yield. Plus, you benefit from capital gain as the overall equity market goes up, right? So if I were to put part of my portfolio in equities, I would definitely consider these defensive stocks, which is real estate, utilities, and consumer staples. Plus, I would still have technology stocks in my portfolio because they are relatively immune to recessionary risks. Of course, every time I tell you that this video is not investment advice, we're just discussing data, but you should do your due diligence before you take any decisions. But what we're discussing over here is that whether the economy goes for a soft landing or a recession, rate cuts are a certainty now, which will obviously be good for the overall equity market. And within the equity market, defensive stocks with high dividend yields such as real estate, utilities, and consumer staples are probably good choices because you will benefit from the high dividend yield, plus you will benefit as the equity market goes up. And technology stocks are still a good bet because in case a recession happens, right, you're not going to see the newer AI-oriented sectors take that much of you're not going to see them take that much of a hit because the growth in these sectors is so strong that they're not going to have the normal recessionary impact come into their sales that much. So they're going to be relatively immune to all of this. Now the question is, why is the bond market so worried? And first of all, what do I mean when I say they are worried? What's the basis point? What's my basis of saying that, right? So derivative traders, fixed income instrument derivative traders, you can see their behavior that what they are expecting is interest rate to go down from 5.25 to 2.75 by next year, right? So they are looking at almost, how much is this? From 5.25 to 4.25 is 1%, then 3.25 another percent, and then 0.5%. So they're looking at 250 basis point rate cuts by next year, right? Which means that the Federal Reserve should start cutting big, and fast. And why do you think the bond market feels this way? It's probably because they can see that the smaller companies and the lower income consumers are now starting to really struggle with this high interest rate, right? And one of the facts is that there is rising credit card and auto loan delinquencies. So what's happening is they can see the cracks, and they are expecting that the neutral rate is definitely a lot low. Now, what the neutral rate means, where obviously the economy continues to stay at full employment and currently unemployment is going up. So this current rate is definitely not the neutral rate. It needs to come down a lot. Now, what that neutral rate is going to be is where the discussion is. Is it 4 or 3 or 2.5, right? So the bond market feels that it needs to come down a lot, and that's what they're betting on. Time will tell that what is the neutral rate and how much the Federal Reserve should cut and how much are they going to cut. So now, on one hand, we said equities will do well, whether there is a soft landing or a recession. But in case of a recession, and if it's a really severe recession, then equities could start struggling a lot as well, right? So what should you do in that situation? Well, you could hedge your position with some gold. Now, why I say that is because what we're seeing is partial de-dollarization becoming plausible. Now, what is de-dollarization? Obviously, countries using other currencies. So we see China, Russia, and Brazil actively trying to use their own currencies for trading. And even though this is something which is not making that much of an impact on de-dollarization, so I'm not saying de-dollarization, I'm saying partial de-dollarization, and that even I'm saying is plausible. It's not something that is definitely going to happen. But what is happening in parallel is that central banks of these countries and others are increasing the percentage of gold in their reserves. And it's not just the central banks, even individuals. And individuals, not just in China, but even in the US and other countries, are more and more investing in gold. And obviously, gold price has been going up, which I don't think is going to stop, right? It's probably going to stay high, maybe even go higher. So what you should maybe consider is that gold should have a place in your portfolio along with these equities that we talked about, right? These defensive stocks and these technology stocks should be there, but gold should be there in case we see a recession. So now let's conclude this week's video, where obviously we would like to see a 50 basis point cut. And you'll find out just in a couple of days because the meeting is coming up. But they might not go for a 50 basis point cut. They might go for a 20 basis point cut, which I think will be a mistake because a recession is definitely something which is on the cards. So ideally, if they go for a 50 basis point cut, that will increase the odds in favor of a soft landing, which will be good. But in case that doesn't happen and we're going for a recession, then you might want to have more gold and you might want to focus more on defensive sectors if that happens, right? So again, whether we see a soft landing or a recession, interest rate cuts are definitely going, they're looking certain, right? Which is good for equities, especially tech and defensive stocks. Such as real estate and utilities and consumer staples. But should you really have a lot of exposure to tech, or would you rather have more gold than tech and still have those defensive stocks like real estate, utilities, and consumer staples? I think keep a lookout on how much the Federal Reserve cuts. If the Federal Reserve cuts 50, then I would have more tech than gold. But if the Federal Reserve cuts 25, then I would have more gold. And still, of course, the real estate, utilities, and consumer staples stays in place in either situation. Utilities especially, obviously, because of the data centers demand, because of the AI chips using the electricity, like we have discussed in previous videos as well, right? So that is it for this week. As always, if you found this useful, please like, share, and subscribe. And please leave your comments below so that we can interact with you. Thanks for tuning in, and we'll see you next week.